As a way of introduction, as academics, you probably know we tend to ask slightly different questions than you might be interested in. So some of the things that I'm going to talk about may not directly apply to what you're dying to know. But I think some of the things that I'll present may help you think about additional items that you'll need to consider if you're going to model price or returns as a function of things, including news. And so hopefully indirectly I can provide some interesting insights that will help you along those lines. So I've been working with RavenPack data for a number of years now. So at least I understand the data, I think. So hopefully I can provide some of that as we go through also. So let me just start by sort of taking a different side of things. So I'm not going to talk at all about the goal to extract information from what's in news stories, okay? So we're going to start with that idea that it's going to be a little bit different. But let me just reflect for a second. Most of us probably sit down at some point and read the news, or on the train or on the bus or before you head to the office or when you get to the office. And so from an academic standpoint, I sit there and read the news and it seems sort of ridiculous, right? I'm not going to use it for anything other than to maybe teach in my class or something. So reflect for yourself, why do you sit down and read the news? And for most of you, it's probably not to come up with new information about a company that you're investing in or that you intend to invest in. And so I'm going to propose, and that's what I try and test in this, is we look at the news for a different reason. And one of those reasons is to keep track of what's going on, right? We're not trying to find out new information about the company. You're probably going to go do that in your own investment research. But you're going to keep track of the news because there's a chance that you missed something. And so by monitoring what's going on in the news, you can kind of reduce the risk that you don't have the information that you should have gotten through your research. And so this I'm going to talk about as the watchdog role of news. The watchdog role has been used they've used it in a different kind of context. So what I mean by the watchdog role of news is the news is going to do the watching out for what's going on with the company for you. Okay? So it reduces the cost of you daily calling up the managers of a company or daily going through all of the information that you could gather, right, visiting all of the stores or whatever it is you do in your investment approach. Because you can just watch the news and see, did I miss something today? And so the press in that case is just providing a service to you to monitor the company in case you miss something. So that's what I'm going to talk about as the watchdog role. So another role that the press has been argued to have is called the investigation role. That's where they're trying to uncover information. So that it's sort of related to what I'm talking about. There are these other roles, though, the gatekeeping and dissemination roles that maybe you don't actively use when you look at news. Then that is the press is trying to filter out information that you don't need. And if you look at the amount of press coverage out there, it doesn't seem like a lot gets filtered out, but some does. And then also the dissemination role, and this has been a big topic in research, is the information that gets released out there gets known to lots more people. So the press can make information that you may want to know available to everyone. And so this could be bad also, right? So there are good and bad things that happen with the press. So let me talk about what I think will happen then with these different roles. So the watchdog role, the one that I'm talking about, how you can use the press to monitor and keep track just in case something happens that you missed. That reduces your cost as an investor to monitoring the company. So I'm suggesting then that the press acts as a monitor that is lower cost, is a lower cost alternative to you looking at the every day going through this process for all of your companies. So what does that mean for you? Well, in the markets in general, I believe that creates a demand for stocks that have press coverage. So then price, independent of the information that the company is putting out there, will be higher for companies that have press coverage. Okay, so independent of the information, higher demand, higher prices. So this watchdog role increases the market value of stocks. Then let's think about the other side. So then there's this bad thing that happens when, let's say you have some information, you've gone and talked to managers. It isn't private information, it's just information that you happen to get. And, or you happen to have noticed that you go to some store or some office and you pick up something and you say, I know what's happening with the company. Now the press goes and lets everyone know that, and you were too slow and you missed out on your opportunity. Or there's what happened for many periods in history, people start trading the wrong direction. And so you face a risk that uninformed investors are aware of the company and suddenly you can't take advantage of your investment because things can go the wrong way. Okay? So this dissemination role of the press can actually make things riskier for you as an informed investor, or it can take away your competitive advantage. So on that side of things, if we control for the watchdog role, I'm going to suggest that my hypothesis is that the dissemination role actually reduces the value of a company, at least to informed investors. And if informed investors are setting prices, then market price will go down with greater news dissemination. So instead of using sentiment indicators and things like that, all I'm trying to do is say, if I have a model of market value and I put in some measures of this watchdog role and some measures of this dissemination role, do I get this effect that higher prices happen when there's a watchdog role because you have lower cost and so you demand a higher price for that stock, or you're willing to pay a higher price for that stock? And then if there's greater news coverage controlling for that, is it risky and you're less willing to hold that stock and so prices go down? That's my sort of beginning hypothesis that I want to test, okay? Oh, I forgot to tell you the measures I'm using. So I don't have great measures. I mean, this is the best I can do. And well, so far, I'm still working on other measures. But what I have right now is the watchdog role. So if you think of something better, but I think this makes sense. So if you think of a company that's constantly getting news coverage, every day there's a news story on a certain company. If you're like me, you read the story one day, you read another story the next day, you read another story the next day, and there's pretty much no new information there from day to day. But the benefit, I think, from the watchdog role is if you know a company keeps getting covered, if something comes out, that information will be available to you. On the other hand, if you get a company that gets covered sporadically, and you hope that when something happens, that information is available to you, you may run the risk that they don't get covered, it gets missed. So for that reason, I'm trying to then measure how much they get continuous monitoring. So my measure is the number of days that the company gets coverage. I think it's okay. And then the dissemination role is controlling for the number of days, how many news stories get covered. Or how many news stories does the company have? And then I'm just going to do a model of market value regressed on accounting variables and these news variables. The hope is if accounting variables measure the value of the firm, then the news variables should not add any additional information if accounting measures capture everything. If they don't capture everything and these hypotheses that I'm trying to test work, then news variables should add additional information in these hypothesized directions. I'll skip this. So then you don't have to see all of this. I'm going to describe it to you anyway. But this is the accounting variables up top are the things that hopefully capture market value. So this is sort of standard in a lot of research. So higher assets, a percent change in asset size is a percent change in market value. Same thing with total liabilities, higher liabilities, lower market value. So these things are sort of standard. Then these two bottom ones with the box here, more news coverage. So this is the monitoring role that I was hoping to get. So the number of days that a company receives coverage is positively related to value. So more monitoring, higher price you're willing to pay. The number of stories, though, once you control for the monitoring role, is negatively related to value. So this was that hypothesis I was talking about. So then you can think about other things that might come out of this. If you believe now what I've said, then you can think of other things that might happen. So if you're relying on, of course, I guess you may not believe what I said, and then we're out of luck. So, but let's just walk with me and believe that you accept what I said. So what else might happen? If you're allowing the news to do all of the monitoring for you, there's a trade-off, right? So if you have a company that you really want to know their value, you call managers every day, you go visit their plants every day, you do something to make sure you're on top of their value, then the value things that they report, they should be priced really efficiently, right? You're going to trade, and the prices are going to reflect the value indicators that they have. On the other hand, if you are not doing that and you're allowing the press to sort of monitor things, they should more or less reflect value, but your ability to kind of trade every time something happens is going to decrease a little bit. So there's a little bit of a trade-off here between constantly monitoring with high costs and letting the press monitor with slightly lower costs, but you're maybe not capturing all of the information that you might want. So if that's the case, then what I should see, I think, is when there is more constant monitoring of the company, the value of the company will be less related to the accounting indicators of value than otherwise. And then the other way around, think about if everybody knows the information. So we're not talking about the monitoring role anymore. Everything gets disseminated to everyone, then the value of the company should be reflected in prices, right? So this is the market efficiency idea. Everyone knows everything, so prices exactly reflect value. So then the value indicator should be more strongly related to market value. So, of course, I went through all of that build-up. It's going to show up the way that I just described it, right? It's not going to be, oops, I was wrong. Well, that did happen when I tried it. And I was like, what if it doesn't show up? And it did, so luckily. So the main effects are the things you've already seen. That's the left-hand side column. The middle column is the monitoring measure interacted with these accounting measures. The third column is the dissemination, the lots of coverage controlling for the monitoring role. And so that's the last column. So what we would expect to see then is higher weights on accounting measures with the lots of coverage. So that's the third column, which is what we see. So in the main effects, the left-hand side column, assets are positively related to value, liabilities negatively related to value. Go over to the third column and you see more dissemination means a stronger relation with assets on the positive side, a stronger relation with liabilities on the negative side. So more information out there, more pricing of the accounting variables. In the middle one, it's the opposite, not quite as strong as in the third column. But in the middle column, we get a weakening of these relations, which is what I would expect if you allow the press to monitor, you get a little bit less association with the accounting variables. Okay? So I think what this suggests, if you are going to create a model of value or a model of returns, and I'll show you something with that in just a second, we need to keep in mind not just the information that comes out in the press, so you don't want to just extract the information that comes out, but you also want to think about the effect that having press coverage will have on price and returns, independent and in conjunction with the measures that you're using to predict market value or returns or whatever you're trying to predict. So then something, this is sort of a side note. Let's see, how much time do we got? Lunch was 12:10? Okay, so someone's excited for lunch. Yeah, so we have, the number of news stories has gone up dramatically over the past 10 years or so. So then what does that mean? Well, so if press coverage is valued because journalists can monitor a company, then as more and more coverage is available, it's less and less, like the journalists can demand less and less value, right? Because they can get the information from anywhere. So then the value attributed to having press coverage, the constant monitoring role, should go down. So that's, again, that's what I find. So that's the top line here. So as press coverage has gone up over time, the value of press coverage has also gone down. Okay? So that may mean something for if you're doing analysis today versus sort of historically. And then the last thing I wanted to get to here is, so we may not just care about modeling value, we may also care about modeling returns. And so this perspective that I just showed you, that the monitoring role and the press coverage dissemination role can have different effects, can affect also your models of predicting returns. So I just wanted to show you that. So if we look at this, the middle, well, it's sort of the left-hand column of the numbers. The news day is the under the intercept, in the boxes, the news day is the 0.143, is the day of the news article. News day -1 is, did you have a news article yesterday? And so the first thing we would look at is this, the current news day. So on news days, positive returns. So if you knew that a company was going to have a news article tomorrow, you would buy the stock for the day. Unfortunately, we don't always know that. And you might interpret that then as saying, that's consistent with my market value story, right? That says, okay, well, prices go up when a company gets constant news coverage. So that, you might think that. But then if you look at, you have to control for both of these at the same time. So the prior day, so prior day's news, once you control for today's news, is negatively associated with returns. So there is this reversal in returns, sort of like what Peter was saying. Without considering any sentiment indicators or anything, a news story comes out, prices go up, the next day they go back down. Okay? And almost all of that, the last column here, is trying to then separate the news monitoring role from the news coverage role. And so the first two lines are the same. Then the next two are interactions with the number of news stories. So I would expect the number of news stories to more closely reflect the lots of news dissemination idea, more than just they have a news story. That's my constant monitoring idea. So you notice once we control for the amount of news coverage, the prior news story is positively associated with returns. So you had a news story yesterday, controlling for the amount of news coverage, you have higher returns today if you had higher returns yesterday. So that means your prices keep going up, which is consistent with my monitoring role idea. But then when you when you interact with the number of news stories, that's these bottom two, all of the reversal comes from that. So revising what I was saying before, if you had news stories before, and it seems like it's a monitoring role, you get lots of news coverage, you're going to have higher returns. However, if there's lots of news stories today, you're going to have higher returns, and tomorrow you're going to have lower returns. That's when the reversals come. So hopefully, I think that provides a couple ways to think about incorporating news stories and news coverage and their effects into your models separately or together with thinking about your other investment objectives, like using sentiment, for example. All right, I think that's it. So if you want to, I'm happy to answer questions. If I don't have the answer, he does. So.
Okay, all right, so let me just start.
I have a few questions, but since everyone just is ready for lunch, I'll ask only one. From what I've seen, what you showed, you said that the news will provide positive return, but doesn't it depends on what type of news? The news could be very negative, and we've seen that the news is negative, and suddenly you see the companies, the price is dropping 15%. So I just don't really understand. Is it on average? I mean, did you separate between good news, bad news? Because usually bad news will affect more, and we know that there's this kind of leverage effect. So that's what kind of I wanted to understand better what you said there. And second, I mean, when you said that it reverses, if I read your results correctly, then the reversal is just a correction. Because it doesn't kind of wash it out completely, just a little bit of a correction. So this.
So not fair. You asked two questions.
Okay.
And not fair. You saw the slides, so you weren't supposed to be able to read that. But so first thing, yes. So it's news overall, right? So there's no sentiment involved in here. So yes, I would expect sentiment to play a role. So what I'm picking up is average effects. So if you get more news coverage, you have higher prices, right? That doesn't incorporate any sentiment in there. So yes, so if you included negative sentiment versus positive sentiment, that would matter also. I was trying to get the part that is independent of what the information is in the news story. The second one, yes, you're right. It doesn't completely reverse. It's a partial correction. That's right.
Okay, we have time for one more question.
Your last slide, we're just wondering, one of your high T-score feature is called intercept. What do you think?
So you mean the high T-scores for the assets and things like that?
There's a T-score 10 for the intercept term.
Yeah, so that has to do with the accounting values don't reflect, they aren't unbiased, right? So there is an intercept that market values tend to be higher than accounting values. That's what that is.
Okay, excellent. Thank you very much, Jeremiah.
Yeah. Thank you.